Okay, the next session, we're going to actually do some practical stuff. We're going to have a panel discussion on practice management and business strategy. And we have Kieran Canavan, all the way from Brisbane or Sydney or Gold Coast? Sydney. By Zoom, yes, in Melbourne the other day. So here we have, and we also have Matthew Swieconek from Findex and Damon Riscalla from Betashares to take us through a conversation around, I guess, environment post-QAR, strategy considerations, how to charge large clients, all that sort of stuff. So practice management in a box. Thank you, gentlemen.
Look, thank you so much, everyone, for the opportunity to talk here today. I'm used to walking around, so it's a bit strange sitting on a chair. But look, thank you for the opportunity. Really, what we're trying to do here in this session is talk a little bit about your business strategy and practice management and where these concepts actually sort of meet and how they intersect. And today with me, just a little bit more about the two gentlemen that are next to me. Damon has joined us from Betashares. Damon is the National Head of Practice Development for Betashares. Damon, you've been in the industry for 26 plus years, worked with a lot of financial planning practices, some of the biggest practices in Australia, most successful ones too. And today what Damon's going to do is going to bring a view from the outside looking into practices. So Damon's worked with so many different practices, he can really give you some great insights. Also, Betashares and Damon have some great resources that are available for any of you that are going to start the journey on building out a strategy. So have a chat to Damon afterwards if you're looking for some resources to get you going. Also joining us is Matt. Matt's joining. Matt's been an advisor for over 22 years. Been with the Findex group for about 16 years, I think, Matt. And a lot of that time was actually managing the financial planning practice within Findex. So Matt's going to bring a slightly different view. Matt's view is going to be around from the inside looking out. Let me get the slides. So the first slide I'm going to talk about is just giving you a little bit of sense. I'm going to start off talking about strategy at a high level. And the important part here, look, first of all, sorry for a very detailed slide. It's not for you all to read now. It's more for reference later. And I'm going to just talk a little bit about strategy. Important, really important, is that your strategy needs to be flexible and it needs to be adaptable to the market environment. So really important. And you need to spend time, if you can, on developing your strategy. Make sure it's written down as well. If you don't have it written down, you just can't do a lot of the things that need to be done. And on this page, if we look at what's on this slide, probably two of the things that I would point out. One is a really obvious one, which is implementation and execution is critical. If you don't implement well, your strategy is going to flop and it's no use to you. So that's important. And if we think about some of the things I'm going to talk about on this slide and the next slide, they're some of the things that I think people miss when they're developing a strategy and when they're implementing their strategy. And the first one is monitoring and evaluation. And if you think about monitoring and evaluation, that really implies that your strategy may need to change. Your environment changes. So if the environment changes, you need to be able to monitor your strategy and you need to change it. The second thing is a lot of the things you're going to do when you talk about process improvement might be using different platforms, it might be using different financial planning software. A lot of those processes, it's going to be incremental change. And what happens with incremental change is there's a concept that is super important, and if you don't evaluate and monitor, you can't do this, and that is to be able to fail fast. So when something's not working, you've taken 4 steps forward, you need to be able to evaluate, has that worked? If not, you need to fail fast, stop, go back and redo it. So if you're not monitoring and evaluating your strategy and how you're implementing it, you cannot fail fast. So I'd say on this page, really, implementation and execution, super important. It's a part that sometimes people forget. You've got to do it consistently, and monitoring and evaluation is probably the first one. Two others, looking at this slide here, your purpose of your strategy. So what's the purpose of your strategy? These elements are important to help you implement a good strategy. And there's a couple on here that are critical. One of them is decision making. One of the main purposes of your strategy is to give you a decision-making framework. So when you're making decisions, whether it's about taking and seizing an opportunity, it might be an M&A opportunity, whatever it is, you need a decision framework to make sure that you're going in the right direction, you're having a look at your vision, everything that's in there, that you are adding value. Also, when you're looking at risks, you need to be able to assess it within a framework. So that framework is really important, that decision-making framework. The other one that's critical and very often not really understood is that communication and alignment. Communication and alignment also talks to culture. And there's a saying, it came from Peter Drucker, who's one of the founding fathers of management studies, and that was, culture eats strategy for breakfast. And what that really means is that if you don't have the right culture, the appropriate culture, your strategy is going to fall flat. And that's because the people that implement the strategy, they really do matter. So your staff, your employees, and the difference between a good company, a good firm, and a great firm often is that culture, because you need, in implementation of a strategy, you need to have enthusiasm. You need your employees to be enthusiastic when they implement your strategy. That's how you get discretionary effort. And that is often a very big difference. So communication and alignment is important. It's not just about telling people, but it's actually getting the buy-in. You need to align with where the staff are going as well, not just where you want to go. So that communication and alignment is a critical one when it comes to how successful your strategy is going to be. At a high level, there's probably a couple of things that the strategy should really help you do. It should help you deal with any challenges that come. It should help you seize any opportunities, and it should help you get to a point that you have sustainable growth. And that's really what you want out of strategy. And I'm covering this off at a million miles high. But it's something that I'd highly recommend. If you look at the really successful practices, those that have grown, they've got a good strategy in there, and they consistently review, monitor, and evaluate. I'm going to hand over now to Damon and to Matt. They're going to give you more insight, as I said, Damon from the outside in and Matt from the inside out, around a couple of practical things that fall into practice management aligned with the strategy. One is segmentation, client segmentation and pricing. Together with that goes client value proposition, and then investment solution. So without further ado, I think I'm handing over to you, Damon.
Correct. Thanks, Kieran. If we can just flick to the first slide.
Minor technicality.
Yeah, look, as Kieran said, I have had the pleasure of dealing with hundreds of businesses, over my time in distribution, and I think one of the first comments I'd make is that, some of the value I'd like to bring today is looking at the commonality between the very, very successful practices out there, and Kieran touched on it just a moment ago. It really is about implementation. The things that we're talking to you about today on this panel, I don't think it's beyond the capabilities of anyone in this room. Really what it comes back to is, are you prepared to take the time and effort to sit down and do some of these things and actually implement? It does get very hard in the day-to-day minutiae of things, dealing with clients, compliance, regulatory hurdles. Sometimes it is difficult to take the time to look at these aspects of your business and planning, but it is what will make you very successful in the long run. So more to the why. Why do we need strategy? We've got 3 silos here that you can see, and I think this pretty well sums it up. That, first of all, from a client perspective, your clients, unless you are a very, very young advisor, you are going to have a number of clients on your panel or your business, within your business, that will outlive you. And they have an expectation. They would like to know what the succession plan is in your business, how you will deal with that. That is something that you can give them comfort around. Obviously, having a clear strategy enables you to build resources in the appropriate areas as well. Secondly, selling your business. At some point, you will get to that decision where you need to either sell or merge, acquire other businesses. But turnkey businesses are very, very easy to sell. So if you've got a clear strategy and process that sits behind your business, it is far more attractive and appealing in the open market or for other companies looking at merging. And lastly, from a succession planning point of view, if you are planning to bring in other advisors and mentor them and retain staff, we know that is a huge issue in the industry at the moment, with staff or qualified advisors having shrunk in numbers so much. When you do find someone who's great, you want to hang on to them. But look, I'll keep moving on. So just in terms of some of the considerations that you want to look at, some of the other components of strategy, once again, there's processes, technology, and client delivery. I think are the three areas that you want to consider. Thanks. Thanks, Kieran. But look, in terms of your processes within your business, fair to say, if you've been doing the same thing for 3 years or more, there's a better way to do it now. And, I think no matter what industry you're in, that rings true. So if you've been doing the same thing for a long period of time, look at some alternatives. Don't be afraid to get external reviews, whether that's from other industries, external consultants, whatever that may be. Bring in outside viewpoints to your business. Technology, there's so much available. It changes so quickly. The way that you can deal with clients, your CRM systems, your paraplanning, automating tasks, that is something else that should be reviewed fairly regularly. And lastly, client delivery. So when you sit down and look at it, do you have an up-to-date investment philosophy, a CVP? Are you doing regular client surveys to ask your clients for feedback on your actual business, and look at the ways that you're delivering service to your clients?
Thanks, Damon. Thanks everyone for attending today, and to the team at IMAP for hosting us. So we've heard from Kieran around the considerations of a successful strategy and the components of that. And Damon's touched on the why. Why do you have it? I guess from my perspective, as Kieran alluded to earlier, coming from a business that I've spent time in over the last 16 years, I'm looking at the how. How do we go about it at Findex in terms of our business planning and our strategy? Now, bearing in mind that our business is, no doubt, quite a bit different from many of those businesses that will be in this room today, but there are some common themes that I hope you can pick up along the way. We're a business of 4 different divisions. So we've got an accounting and a tax division, we've got a wealth division, a consulting and an audit division, and about 15 different service lines that live underneath all of those different divisions. So it's quite a corporatised model that we're operating in. But at the group level, starting from a top-down perspective, the Findex executive will set a 3 to 5 year strategy, and we're midway through our most recent strategy. Every division within the business, each of those 4 divisions that I mentioned earlier, will then set a business plan that aligns with that strategy. At a local level, from an advisor's perspective, and bear in mind all of our advisors in Findex are employed by Findex. We don't have any self-employed advisors that sit under our licence. All of our advisors are required to submit a business plan every year. So we have 110 advisors across circa 60 locations throughout Australia and New Zealand, so a very broad geographical footprint. So making sure that we have consistency and discipline around the preparation of these business plans is paramount. So in the lead up to the end of financial year, there's a month and a half long process throughout April and May that will kick off, excuse me, where every advisor is provided with a standard template, and that template covers quantitative and qualitative components to it. So from a quant perspective, the typical growth and new client metrics that you would expect from your advisors who are wanting to set their objectives for any given year. But in addition to that, there are also qualitative components. So if there are areas of specialisation that advisors wish to pursue, what are they? How can we as a business support them? What is some education that the advisors may require to get to that point? And we also in there ask our advisors to complete what we call an ideal week, which is a very simple but an effective tool. And again, it really comes down to the whole accountability to the whole business planning process. And the ideal week is really asking them to segment their days so that they're setting aside time specifically for the activities that they say they are going to pursue within their business plan. And I guess from a lessons learned perspective, we've been running this type of process for the last 6 or 7 years now, and it's evolved each year. And from a lessons learned perspective, I think in the early years, we probably weren't strong enough on the accountability side of things with business plans. They were left the chance. We got to the end of the financial year and had the annual review and wondered why things weren't achieved that the advisors said were going to be achieved via their business plans. But as a business, we reflected and recognised that we needed to put in place regular ongoing check-in mechanisms with our our line managers to make sure that our advisors are actually being held accountable to the activities that they say they were going to do. And our results, our new client results and our growth results have grown exponentially as a result of some of those very simple tweaks. And for us, it was really a case of just starting somewhere with this. And this won't be the last evolution of our business planning process. But if I can implore you, if you're not yet doing it, start somewhere from the ground up and don't be too complex in terms of the process that you're putting in place. Go back a step. There you go, Damon, over to you.
Yeah, thank you. Thanks, Matt. This is, just a shameless plug for what we're doing at Betashares. We've got a huge commitment to the advisor market. We do recognise that it is a super tough environment, and it's become more so, over the last 3 to 5 years. So as part of our commitment to the Australian marketplace, we're in the process of developing our practice development toolkits. We're bringing out services to clients, advisors like yourselves, and we're looking to make things easier and easier for you. So on our practice development page, we do have a number of tools. It covers issues like business planning, client value proposition, referral generation. So if you haven't had the time to do it off your own back and you're looking for an easier method, check it out. Check out some of our tools. It may give you a bit of a shortcut. Look, something else that we think is incredibly important is developing a client value proposition. Can I just get a show of hands? Who's got a documented CVP in their business at the moment? A few, okay. Obviously a few that don't. And what we typically find is that those that don't probably have some sort of idea where their real value lies, but obviously it's always a very good idea to document it. It makes it far easier to communicate to your clients exactly what it is. If you're looking for a framework, we've got something up on screen here which you may find useful. First of all, look at the strengths in your business. Try and identify what those are, work within those parameters. Have a look at what differentiates your firm. So one of the things that we always look for when we're talking to businesses is look at what you do that's quite unique, but also areas that you perform at a very high level. There's no point building a CVP around things that you do if they're not very unique and you don't do them very well. And often that may be a case, it might be risk insurance, which you do one or two cases a year. Clearly that's not something you want to build your CVP around. So the real power of it is that intersection. If you find something that's very unique that you do in the market and you do it very well, that's what you need to focus on. Look, lastly, I'd say putting it down on paper and then spreading the word is also a huge part. So get it onto your website, talk to your staff about it, make sure they're across it, put it in your marketing materials, everywhere that you can, and talk to your referral partners as well about it. Something else that we think is very, very useful and that every business should do is looking at segmenting your client base. Why is it important? Well, clearly, knowing what's in your client base is hugely beneficial, enables you to delegate resources to the right areas. Often what we find is that a lot of businesses have picked up legacy clients along the way. Tendency when you first start out to try and grab any business you can. You get 5, 10, 15 years down the track. Those clients now aren't naturally a good fit for your business. So sometimes you then need to figure out what to do with those clients. One of the things we talk about is move up or move out. So, if you've got clients that you feel you're not servicing particularly well, maybe not generating, they're not prepared to pay for it, you need to have a chat to those clients and either move them up, get them into those service packages that you offer, make them more profitable, build that relationship, or otherwise look to move them out. And whether that is, selling off a segment of your client base, whether it's having the conversation and doing a warm referral to another planner who specialises in those areas, there's ways to do that. It also helps you have a look at whether you've got some gaps in your client base. If your client base is predominantly 75-year-olds, you're going to have an issue because those clients are in drawdown and they'll progressively be dying on you. Looking at those gaps is hugely important.
Thanks. So in terms of the methods of segmentation, look, there's no perfect formula for how each business decides to segment their clients, and it really is going to be down to the individual business. I'd suggest taking some counsel from colleagues in the industry and people that you know. Do some research in this space before you start embarking in it. But I guess some of the more common methods that we see out there in the market for the purposes of client classing or segmentation is by either single attribute, so categorising clients by their revenue to the business. That could be either directly to your, say, financial planning division, or it could be a whole of firm source of revenue if there are different service lines that you're conducting throughout your business. It could be a fund-based segmentation, whether that's individually or by family group, by stage of life, accumulator, pre-retiree, retiree. You could have business owners, or via complexity, that low, medium, high, just very basic. And they're just an example of some of the single attributes that you may choose to use when segmenting a client base. Or you may wish to be a little bit more granular or take a little bit more of a complex approach and use multiple attributes. That is, look at several or more of those single attributes, and you may apply a weighted score to each one of those to give you a point score outcome that then helps to categorise your clients, because you might have various measures there that are important to you as a business, and they might be things like revenue, they could be FUM, but there are also other attributes like growth potential and whether or not that client is a source of or an ongoing source of referrals to your business. We'll have some of our clients that are in our highest client tiers that don't necessarily generate substantial revenue, but they are substantial referrers to our business, and we want to recognise the value that they bring to us. So then in terms of the how, from a Findex perspective, I like to categorise them as a primary and a secondary a form of client segmentation. From a primary or service perspective, we have 4 different distinct client categories that we segment our clients into. Now, what I would say is we started this journey, I'd say about 14 or 15 years ago now. And again, from a lessons learned perspective, what I've really taken from that experience is that we tried to overcomplicate it early days. And if there's any advice I could give is to try and keep it as simple and neat as you possibly can, because the challenge that we ran into was really the difficulty of differentiating service between the various client classes that we had. We just had too many of them, and the differentiation between them wasn't wide enough. So we went back to the drawing board some 3 or 4 years ago and consolidated our client segmentation down to 4 neat tiers. And that won't be the end of the evolution. It will evolve from there at some stage going forward, but where we sit at the moment really fits us. It's a revenue and complexity model, and as I said, we do have some, say, referral sources or family members, etc., that will fall into our higher tiers because of their association with other clients within our base. And the CVPs that sit within each of those, we call them client tiers, will cover things like defined touch points, communications that we're sending out, events, service agreements or service levels that we have for certain tasks, obviously the timeframes within which we commit to getting those things done for clients. And all of these service offerings, or our CVPs, are documented through a client service agreement that are signed off on by ourselves and our clients. And each year we're documenting those back to the clients in our ongoing fee agreements, just to make sure that we're being kept accountable to doing what we say we're going to be doing. Because in the absence of that, we have a fee for no service issue, and that's obviously something that we don't want to be held for. From a secondary perspective, this is really more so around our marketing activities. As I mentioned beforehand, we've got 100 different locations around Australia and New Zealand, so we have a lot of location-based events and functions. So being able to use our CRM to segment clients in certain locations. We're doing a lot more now via webinar, so being able to segment clients at certain age brackets or if they're business owners for certain topics or of interest that we're rolling out. And we do have the luxury of having multiple service lines with clients in our accounting and tax and audit client bases that also get invited to these sorts of functions. So it allows us just to broaden the net of people that we can segment into those categories. Over to you, Damon.
Thanks. Look, one of the other things that we always think is critical to think about is how you price your services. There's lots of different methodologies out there. We've clearly seen them change over time. I think historically the AUM percentage model was something, we've seen that being phased out. We still do see some businesses that price this way, but clearly thinking about how you price your services is key to a number of things. It's key to how you target profitability. It's key to making sure that the products that you're using enable you to charge as you do. It's also about communicating value to your clients. But on the percentage-based AUM, there's a couple of benefits. Clearly, it's inflation-linked. Markets rise over time. You get increasing fees out of it. Clients feel you're in the same boat with them. If markets decline, you're sharing the pain. So that can be comforting to some clients. There are some disadvantages. It can lead to overcharging or undercharging. So one of the biggest issues we see is cross-subsidisation, where clients with huge assets are paying substantial sums of money for advice. They're probably not quite getting the amount of service they should. Other clients that may have lower amounts of assets are chewing up more of your time, and it's a case of cross-subsidisation. So the flat hourly fee, something that everyone would be fairly familiar with. We see it more often in the accounting, legal professions. We still do see some advisors that adopt this methodology as well. Clearly, there's a link to complexity. The longer it takes you to do something, the more you're able to charge. It reflects the effort that you need to put in to complete the work. It does, however, require billing. You've got to actually go out and collect the fees. And the other big disadvantage is it doesn't really encourage you to become more efficient in your processes, because you're still going to be getting paid no matter how many hours you're doing. So that is one of the big drawbacks with that. Service packaging. So this is what we're seeing more of out there in the market. And this is where you have predetermined service packages, whether it's whatever you might call them, whether it's gold, silver, bronze, platinum. But this is where you lay out on the table to your clients, here's the options, here's the service levels, this is what each package provides. It smooths out work over the year, it's easy to advertise, and it's easy for clients to understand. Cost plus pricing. This is a methodology where you need to sit down, use a cost to serve calculator, figure out your fixed overhead costs, your variable costs, which are more often than not the cost of staff and the preparation of your plans. You then build in, allocate those costs, build in a profit margin, and you charge each client respectively. So it is easy to establish once you've got it down and you understand your costs that you're incurring. You can use that repeatedly. So this is something that we're starting to see a little bit more of as well. And lastly, capacity and value-based pricing. This is something that's becoming more common overseas. And what this is, it's a basis for charging where you're demonstrating overall value. So in a financial planning context, it might be about talking to your clients about the value of having them in the right risk profile, the value of having the right insurances in place, the tax benefits, retirement strategies with tax savings. So it's about demonstrating that overall value and charging on that basis.
Okay, so they're the types of the most typical pricing methodologies. In terms of the considerations before you start setting a methodology. So what is your value proposition? We've spoken about that at length today, but that really is fundamental to everything you do, and that bleeds into the pricing methodology. What's your point of differentiation? Where are you different in terms of the service and the value that you're offering to your clients? How well do you articulate your value prop and your unique selling proposition? So back to what Kieran was saying earlier on, are your advisors buying into the value proposition that you have? Because you can have a very strong one, but if there is a lack of belief in what's being offered to the clients, then that will shine through, and it'll be a very difficult proposition to get that across the line with your clients. Is it a structured pricing policy? Do you have it documented, or is it very much in the hands of individual advisors to make up on the run, to negotiate with clients on an ad hoc basis? And also, are you keeping an eye on the competition? What's happening out there in the marketplace? Now, obviously, we believe that where there's a perception of value, there is the capacity to obviously charge more, but obviously there is a need to keep an eye on what's happening out there in the market as well. So in terms of how we adopt this or how we manage this within Findex, we have what I call a dual pricing methodology, and that really aligns with our value proposition to clients, and that is we have two distinct services that we provide to our clients, which is the financial advisory service, but we also have an investment management capability in-house within our business. We have an in-house investment team that conducts all of our own internal investment research and constructs all of our model portfolios and portfolios for all of our clients. So each one of those components has a separate piece of value that is provided to the client, and the clients really appreciate the different components and the different value that each one of those different components provides to them. And as I said beforehand, gives us the capacity to be able to charge, because clients appreciate that there are two distinct valuable services that they are getting when they come and see a financial advisor at Findex. So firstly, there's the advice fee, which is typically a dollar-based advice fee for service. Now that is what we call a job costing model plus, or a cost plus model, as Damon mentioned beforehand, with layering of risk and complexity. So additional layering if there is additional risk and additional complexity in that client circumstances. Importantly, it's a standardised, you're probably getting a picture here at the moment. We try and be as consistent with everything that we possibly do across our business given our footprint. So we have a standardised methodology, a standardised rate card, pricing calculator that we use across the board, so that a client that walks into our office here in Sydney of a similar type gets the same outcome as they do in Toowoomba or Launceston or Hobart. Where there is an investment mandate, in the majority of cases there is, we have a separate, what we term a portfolio construction fee. Again, that is either a percentage or dollar-based fee, depending upon client preferences. That will be influenced by the type of implementation methodology that we have. Obviously, if it's a client running on a managed account, whether it's an MDA, SMA, IMA, or whether they are operating on an SOA. Obviously, there's more work involved in some of those structures, so there is a commensurate difference in fee that we charge. But again, that is a standardised fee card, a rate card that we roll out across the country. So we have a very standardised fee structure that we're all using. So the combination of those two is the total fee that's then levied to the client's account. And the important component there is that will be across the entire family group. So if there are children and family members and so forth, they will all be consolidated under the one family group from a pricing perspective.
Okay, so the last componentry, if you like, that we're looking at today is creating an investment philosophy. And once again, we think it's critical for any financial planning business to have this documented. It needs to be shared with clients. Clients need to understand the expectations around investment returns. They need to understand what your beliefs are and your approach to markets. It also feeds back into your client value proposition. So there's a ton of different options out there, and it's not wrong to have a different philosophy for different client segments. So that is something that we think works very, very well. But as part of that, you need to consider other things or other aspects, things like rebalancing strategies, tax considerations, turnover. So there's a number of things there, a number of components. I think it's critical that you outline these, that in your own mind you have a very clear belief of what you're doing and that you're able to outline it to your clients so that they understand the expectations. It helps you set up resources from a governance perspective. You can set those resources to exactly what you're doing within your investment philosophy.
So in terms of the development of an investment philosophy, start off with why. Why do you need an investment philosophy? Well, from our perspective, if you want direction, if you want clarity, if you want efficiency within a business, it's important at the highest level to have a documented investment philosophy. It really is that roadmap. It sets the framework for all of the investment decisions that are undertaken across the business. It leads to consistent outcomes. You're not getting variability of returns and outcomes and portfolio choices for your clients. Efficient allocation of resources. So you're not pivoting towards all different variety of different style and investments and managers and platforms and so forth. You're able to focus your resources, your systems, processes, communications in the same area. It helps to mitigate risk. You're giving the goalposts within which people are required to work. Takes away any of that behavioural bias that can creep into investment decisions and removes some of those emotional decisions that people may otherwise be guilty of making, and we're all guilty of those from time to time. And overall, it really does ensure you have a disciplined approach, particularly if you have those well documented and they are directed from the top down. So that's the why. In terms of then how you do that, where do you start? Okay, from where we sit, the most important component here is really to consider the governance of your entire process. So do you have an investment committee in place? What does that look like? Who are your voting members? What sort of decisions are they making? Do you have any independence on there to remove conflicts of interest within the committee structure? Then to the asset allocation, how many risk profiles are you supporting? Do you have a strategic asset allocation that's overlaid with tactical or a dynamic asset allocation? How frequently are these reviewed, and are you taking any internal or external advice to arrive at these decisions? Portfolio construction, so who's selecting your investments, who's doing the research on your investments, how are you blending those investments, and what methodology are you employing? Are you looking at an active, passive, hybrid? Are you including alternative assets, unlisteds? There's a whole myriad of different considerations that fall under that. The next one, although it's number 4 on the list, is quite possibly the most important. It's execution. Making sure you've got the resources to actually execute on all of the decisions from an asset allocation and portfolio construction perspective, because in the absence of that, the rest of it falls flat. And then, of course, communication out to both advisors and clients, as Damon was saying. Document it, make it known to your clients and advisors, and keep it consistent across the board. Now, I'm getting mindful of time because it's turned to the red. So I'll go through the next lot. So again, that's the mechanics of the components of considerations and why and how. This is how we do this, or we run our investment philosophy at Findex. So from a governance perspective, we have a centralised investment committee, and we have voting members from senior management within our business, C-suite members of our business, advisors. We also have 3 independent members that sit on our investment committee, one of whom chairs the investment committee, Dr. Joe Collins. And each of those 3 members have the right of veto over any decision that's put forward to the committee. So they can veto any decision either in isolation or in combination. We meet on a monthly basis, and we oversee all investment decisions that are made, all asset allocation and portfolio construction decisions. From an asset allocation perspective, we support 7 different risk profiles across the group. We have an SAA, a strategic asset allocation, which acts as our anchor. We review that every 3 to 5 years for every one of those risk profiles. And we have a tactical asset allocation overlay, which is reviewed every month around the strategic asset allocation. Now, we take input primarily from State Street Global on our macro asset allocation piece, but that's also then consolidated with our own internal research function, and we use a number of other external global managers to help us with that. It's like the doctor's second opinion, I guess, if you will. I'm going a little bit blind to read my notes there. I think I'm covering everything. My apologies if I'm not. From a portfolio construction perspective, as I mentioned, we have an internal investment management function, so all of our research is done in-house with our managers, so they will conduct all of our site visitations, all of our negotiations with managers, from a unit class mandate perspective, fee perspective and so forth. They will blend all of our portfolios, and our advisors are expected to follow those portfolios across the board. So it really is a top-down mechanism. Our advisors don't construct their own portfolios. There is a mechanism for advisors to tailor and customise if needs be, but in the main, our advisors do follow our model portfolios. And as I mentioned, execution, primarily we use an MDA. We have about $9 billion that sits on various platforms within our managed discretionary account. So that is our primary method of execution, but we also do support SOA clients. We have a back office administration or support team of how many, Kieran? Probably 15, 20 people, whose prime role it is to facilitate execution across the 11,000 accounts that we have sitting on our managed discretionary account. So it's a big industrial sized beast, but obviously we need the resources to facilitate that. And just from a communications perspective, the minute we walk out of our investment committee meetings, we are holding briefings with our advisors in terms of any changes that we have made. Our rebalances take place a week or two after our investment committee meetings. We're communicating out to clients shortly thereafter. So we are making sure that there's a steady flow of communication after all of that. So it was all death by PowerPoint, and I do apologise. There's a lot of territory to cover there. We are an open book in terms of the information that we've shared here today. More than happy to have conversations offline, field any questions that the people have. So yeah, we've got 2 minutes left, Toby. I do apologise. So please ask away.
Yep. Yeah, no, look, they've covered such a lot about running an advice business. So questions from the floor. Because to my mind, one of the most, do you want to go back a few slides to your pricing strategy? That one, yeah, that one there. That seems to me to sort of sum up so much of what it is that we all set out to do, which is we do two things here. We give advice and we charge for that, and we are wealth managers and we charge for that. And this seems to me to sum up one of the fundamental sustainable business models for advice going forward. The capacity.
I think, Toby, you're absolutely right with that. One of the things, and Brett was a big part of developing this from Philo in the early days when we started doing this. One of the incredible things you have to be able to do, and you need to be able to do it well, is you need to be able to explain to clients the value. Because people will pay for what they perceive is valuable. And they'll pay more for something that they perceive is more valuable. When you break it down like this, the fact is all that money that's collected there is allocated to advisors. It's not allocated to different teams, it's allocated to the advisor. But it really helps explain to the client the value that the firm and the advisor brings to them. And it just helps it, and that's why we split it up. So it's not just those two, it's the pieces below that as well. Because advisors do so much for their clients. A lot of it's education. You know, when times are hard, it's really a steadying hand that's there. It's about explaining that value proposition. That pricing methodology just helps. That's all.
Other questions?
Thanks. Damon, you mentioned about it's all right to have different investment philosophies for different clients. I mean, we're all used to some clients are balanced, some are growth, etc. But just wasn't quite sure what you meant by that.
Yeah, sure. I think what we're seeing increasingly is, in certain cases where a client may have a real need for in-depth investment management, and that might be in a structure like an MDA or an SMA. You may have other clients that are far smaller balances that are still prepared to pay for advice, but the investment approach that you take for that set of clients can be far different. And there's a lot of considerations there. The levels of service, the amount of interaction that you want to have with the client, and vice versa, the amount of investment education that they will require. But the point being that we do see increasingly where people will say have a very active portfolio, that might be an SMA, and then they might use a diversified fund or an index approach for clients that are a little more hands-off.
Are we done? Thank you, gentlemen. Put your hand together.
very much. Thanks,
for
everyone.
Kieran, Matt, and Damon. Thank you.